All right. So good evening again, everyone. My name is Simeon, like I mentioned earlier, and I'm the lead tutor for the center. So this afternoon, I'll be walking through this important topic with you: analysis and interpretation of financial statements. And because we have, different levels in this class, we've decided to make it a very long class so that we can accommodate everyone and, your questions as well. So this class is primarily for the case study guys, the CR guys, and the FR guys, right? And then secondarily, we've also mentioned that the or SFM guys and PM guys can also join. And I think I omitted PSAF is also, PSAF is also, part of the people, uh, you know, that are supposed to join this class primarily because it's part of the topic that are testable in PSAF if you check your syllabus. And you're wondering why is this topic everywhere? We've started recording, yeah. So why is this topic everywhere? So it's an important one. So it's probably the most important topic as far as the entire ICAN syllabus is concerned, right? Probably, right? And why is this so important? This is because accounting is all about people see accounting as all about dealing with numbers, just calculating, balancing figures, preparing financial statements, and all of that. But this is the aspect of accounting that gives you the opportunity to make sense with those numbers, right? To be able to analyze performance, to be able to analyze trend, to be able to forecast, to be able to predict, to be able to, just make sense with those numbers that you have been busy crunching day in, day out, right? So, financial statement analysis is a very key one. Whether you are even an accountant or a finance professional or any aspect of accounting or finance that you're dealing with, this is a topic that will always, that will always be important. Even as an auditor, you carry out your analytical procedure. It's all about financial statement analysis. Even as as a finance analyst or as a CFO or a controller, right? So you want to report budgets, performance, you want to do a whole lot of things. You need financial statement analysis. Do you want to talk about finance professionals, valuers now, right? Guys who do equity valuation, debt valuation and all of that. You also want to incorporate financial analysis into the process to be able to understand companies' financial performance. So a whole lot of guys out there, irrespective of where you are in finance or accounting, you get to use this aspect very well. And just to wrap it up, right, is it is that aspect of accounting and finance that captures a behavioral aspect of the numbers you deal with every day, right? So and that's why in this class we are going to really emphasize for you that it's not all about calculating numbers. You need to be able to understand what to relate to those numbers and make sense, with the numbers, right? So financial statement analysis. And this class, we've also structured it in a way that we can spend the first 2 hours to actually discuss the calculations, the formulas, and all of that. And then the second aspect of this class is just nothing but to come and understand how to really, really interpret those numbers and make sense with them, right? And that's how we've structured this class. So if you're attending this class, ensure you don't miss the second one because this class will, focus on the calculations, the formulas, and all of that. The second class, like I said, is interpretation. And then the last part of that class, the last part of the interpretation, is where we will now maybe spend 10 to 15 minutes discussing specifically how the interpretation relates to case study, how you need to do your interpretation when you are talking about case study, talking about the professional level guys now. And that's the structure of this class. So there was a question earlier. If I get your question correctly, I think you said you sent it to the before we started recording. So I told you I'll leave it till we start the class so that I can capture it. So is this topic the same as performance appraiser in PM? Yes, really. And if you go and check your performance analysis, performance appraisal, those topics you have in PM, which you have done anyways, but you realize that you have those formulas there, right? Things like ROCE, we've not started, but things like ROCE, some return calculation. Okay, I think permit me to control to just okay. Okay, I think it should be better now. I'm sorry I had to, enable that control such that we reduce the side noise, right? So it's the same one you have in PM, which is why I've also communicated that, the PM guys are encouraged to join. The same thing with SFM guys. This has been tested in SFM before. I remember a diet like, is it November 2018 or May 2019 now, one of those two diets, right? They tested this as 20 marks. And even apart from that, in a topic like merger and acquisition, speaking to the SFM guys now, in a topic like merger and acquisition, understanding in detail how to really run around and walk around your investment ratios is very key, right? If you don't know how those ratios relate and how to really walk around them, it's possible you are not able to navigate some questions in merger and acquisition. Okay. So let's get started. And I mean, it's possible most of us, must have come across financial analysis and financial statement analysis and, whatever it is that it was called when you did it in the past. But I need someone to, first of all, tell me what you understand by financial statement analysis. Let's put it that way. Not financial analysis, financial statement analysis. Hmm? You want to give it a try. So if you want to try, you can raise your hand and then I can um I can allow you to speak. If you want to help us define what a financial statement analysis is all about. I can't see any hands raised. Do we have anyone who wants to try? Okay. Okay, so Faye, you can give it a try. Let's go.
Um, Basically, what I think I understand as financial statement analysis is that maybe a companies or accountant or team of finance trying to look at their financial statement to see the levels of the liquidities, the levels of profitability, investment wise, then asset wise, and how sustainable the companies can be. That is, maybe is this companies making profits compares to last 3 years, or is this company making profit compares to first quarter of last year? What are we looking at? Just like more or less like a projection to help us to make a projections after we might have analyzed the previous years or the current years to make it help the management or the board of directors to make a decisions.
Thank you very much. And what you've done is you literally captured different aspects we can even try to touch if we are performing a financial analysis. But and that's a very good one. So I then need you, maybe if you want to give it a try, Abdul, you want to give me a summary in terms of what everything that he has said. You want to summarize it by, a simple definition of what financial statement analysis is. Abdul, do you want to try, or maybe something else you wanted to say anyways?
Let's try and summarize it. I think
Great.
financial statement analysis is the process of reviewing a company's financial statement to make for the organization to be able to make economic decisions, maybe earn more profit for them.
Okay, makes sense, makes sense. Thank you for that. And then we'll be moving on. Let me just touch what you guys have said. So if I, Faye mentioned liquidity, profitability, different aspects really, which we are, we are still going to be discussing. And then one thing I really need to pick from what you've said is that we are doing all of this to be able to make decision is very important, right? And yeah, so financial statement analysis is just you analyzing the relationship, between these numbers in the financial statement to be able to make decision. It's as simple as that. And if you look at what I've said, I said analyzing relationship. So sometimes it's not just for you to work on the number and say, oh, this increased. Oh, it's very fantastic. It's good, right? Oh, this decreased. Oh, it's bad. What can we do? So sometimes it's not really about that. So it's a matter of, so you looking at the holistic picture to understand the relationship. You want to know what is really going on. Sometimes a particular number is going down and then you are interpreting it to be a good performance, right? Sometimes, let's ensure we are all muted. Okay. So sometimes you don't have to, sorry, 1 minute. Okay, just 1 minute more. Okay, so I can control the class, like I said, but because I also want it to be a very active class where people participate, what I do is, I went back, to remove. But let me just mention, Mendy, that's Udemy Mendy. Can you ensure that you're muted at all time? Can you hear me? Just to be sure. Okay, please, let's ensure we comply. It's a class that is very large and we need to ensure that it's a smooth one. All right, so that's what financial statement analysis is all about. So, just moving forward is, if you look at the screen, I mean, before we get to, serious aspect, let's look at this techniques for analyzing financial statements, right? It says you can do a common size analysis, or you can do a ratio analysis. This tells you that financial statement analysis is not the same thing as ratio analysis. Ratio analysis is only one technique for performing a financial analysis. As a matter of fact, there are even other methods that are not here outside, should I say outside your syllabus now, right? So you need to understand that ratio analysis is only a technique for performing a financial statement analysis. So just because of professional guys as well, it's very useful for them to really know how to do a common size analysis. For those of you in skills level, you are still going to professional level, and it's a very simple method. We'll discuss it briefly, and then you need to take it away. How you need, or how you can do a common size analysis, right? And then after that, we start ratio analysis, and then that's basically the two methods we are going to be looking at, right? But before we go, let's look at how you can apply these techniques, right? And we've identified three ways, three different ways you can apply these techniques, either a form of vertical analysis, horizontal analysis, or a trend analysis. Let me allow someone to read for us. And when you read, you tell me what you understand. Whoever is reading, you read these 3 bullet points and you tell me if you will be able to distinguish between these 3 from this. And then I'll just chip in. Who wants to do that? You need to use your raise of hands before I call you. You want to read and explain to us what's the difference between the 3? I need participation. So don't be scared to raise your hand. I'll call names if I don't see hands. Okay. It's so funny that I mean that I wanted to call you Adebimpe and you actually raised your hand. I don't know. I'm being very sincere now. So please go ahead.
Okay, good afternoon, everybody.
Yeah, good
So,
afternoon.
yeah, making sensible comparison sits at the heart of financial analysis. There are different types of comparison that might be made, including one, comparison within financial statements. For example, if revenue has increased by 10%, by sorry, it
Yep,
might be
that was the
expected that
network.
gross profit increased by a similar amount. Vertical analysis. Two, comparison over a number of years. Can you still hear me?
Yes, we can hear you.
Okay, comparison over a number of years. By looking at the ratios of a company over a number of years, it might be possible to detect improvement or deterioration in the financial performance or financial position of the entity. Ratios can therefore be used to make comparison over time and to identify changes or trends. Horizontal analysis. Comparison with the similar ratio of other Comparison with the similar ratio of other similar companies or to industry average for the same period or over the same period. Vertical and horizontal analysis.
Analysis. Okay, so you want to make comment on that? And yeah, just
Okay,
what you
so
understand.
yeah, I think what I understand is okay, like there are different ways we can, do a comparison with the financial statement analysis, maybe like looking at, okay, how was the profit, like, in comparison with the revenue, maybe in comparison with revenue, how did each line items of the financial statement, how was the performance like, or how can we measuring, each line items of the revenue in compare of the financial statement in comparison with the revenue. I think that was what the first bullet point is talking about, and
Which
then
is
we can
called
also
vertical
vertical
analysis.
analysis.
And you can
Yes,
even be doing that within the same year, right? Let's even say
yes.
2024. And you're just looking at, oh, we made this high revenue. How come we reported loss? How come? Okay, let's look at the expenses to see how you've done. Okay, is it that? So those are the things you can do within the same year. And when you are doing that within the same year, it's called vertical analysis. Okay, so what about horizontal? Go ahead.
So, and that's over a number of years. So you can now also, we can also do this, this same bullet point over the number of years. We can compare, okay, each line item, looking at it over the number of years. And then there could also be ratio, now calculating ratios, maybe like gross profit margin, looking at ROCE, over the period of over some certain period of years. Now, that is like a trend analysis. That is horizontal analysis.
Thank you for that,
Okay.
right? And I will just because of time, I will not be able to entertain more addition to that. Let me just summarize it. But the message is very clear. You're doing your analysis within the same period, maybe by comparing your bottom line with revenue or maybe cost to revenue, just to see how you've performed, you know, in relation to your revenue or in relation to a particular item. You call it a vertical analysis. But if you are doing this analysis over a period of time, right, you can call it horizontal analysis. And if a special form of horizontal analysis is trend analysis. In fact, you can do 2 years and call it horizontal analysis. But when you do an analysis, let's say you do an analysis over a 5 year period, 3 year period, 4 year period, that's clearly you can call it a trend analysis, basically, right? But you find out that in financial statement analysis, you don't employ just only vertical and or maybe just only horizontal. A robust analysis will be a combination of both vertical and horizontal analysis, right? Where you are analyzing within the same period and you're also analyzing over a period of time. You're probably analyzing trends to understand their performance over the years and, just to make sense with the numbers really. And that's what your analysis is all about. So let's talk about stakeholders really. Let's talk about stakeholders. And for this part, I have mentioned, for those of you that are offering SFM, we had a discussion around this, where we talked about stakeholders, conflict of interest, what each of them, really needs. And for those of you that are offering CSME, you'll find out that, you don't focus on this aspect, but you do we teach you to actually understand different stakeholders and their interest, right? And even how to manage them. A framework like the Mendel's framework that you use to analyze and manage different stakeholders, from knowing the stakeholders that you need to keep informed, the stakeholders you need to keep satisfied, the stakeholders, different type of stakeholders, as you have in your Mendel's framework, are things that you can also connect to what we are doing today, right? So look at what we have on the screen, telling you different guys that use your financial statement or financial information, right? From investors to lenders to employees to suppliers to customers and to these guys, even government, right? You're wondering, what is the most important ratio to, let's say, what are the important ratios to a lender, right? A lender is lending you money. I just want to tell you what I'm trying to show you here. A lender is lending you money. The most important thing for that lender is your ability to pay him back, both the principal and interest, right? The lender is not, although your profitability is important because it's connected to what the interest of the lender is, your ability to pay him back, because it's only when you make money that you'll be able to pay him back, right? But your lender is not interested in things like your tax, how much tax you pay is none of his business. The lender knows that he's prioritized before tax, right? So the lender is probably looking at the number of time you are able to make profit before his interest, the extent to which you can cover. So interest coverage, for example, is a ratio that we compute, and that's a very important one for lenders. A lender is looking at how much borrowing you even have at the moment before he lends you money, right? I hope you are not the type that have collected loan from everybody and then we'll now give you our own too, and then you're finding it difficult to pay. So your current gearing level really matters to lenders. And so you need to know which, for you now as an employee, if I may ask, which ratio do you think is important to you? Which ratio? You can think of anything from your understanding of financial statement. You can even give me not a popular ratio, a ratio that as an employee you'll be interested in computing and knowing. Tunji, you can go ahead. I think you should be able to speak. As an employee, are you able to unmute yourself? Okay. Tunji, I guess you raised your hand by mistake. Do we have any? Okay. Inoluwa, do you want to speak to that? Okay. So I'm not looking at it that way. I'm not looking at it in buckets. I'm not looking at it in buckets now. I'm looking at specific ratios. For example, I talked about lenders and I talked about interest coverage, right? So because we've not looked at the formulas, you might not even give me specific ones. But okay, let me just allow you to get there and then I can be asking these questions. But let me just tell you what I'm expecting. As an employee of an organization, see, the most important thing to me really is my salary. Although I can also bring in job security, and for job security now, maybe there are ratios you're able to use to assess that, but let's just focus on the salary. I probably want to look at the portion of maybe salary to total expense ratio. Right, I can be thinking about that. If I have those information before accepting some remuneration, some package from the organization, I can use it to assess, especially, for example, it's possible we are not talking about an analyst. It's possible we are talking about a CFO or someone who will come in and take a management role, right? Someone that will even do a due diligence on you as an organization before taking your offer, right? So I can choose to do those analysis to say, oh, what's their payroll looking like? I can demand for I, I can demand for your payroll before accepting your offer. Send your payroll for the last 5 years. right? Let me use your payroll to assess, maybe attach your bank statement as well. Let me do my proper due diligence before I commit myself. I mean, I'm just joking, but I'm also serious at the same time, right? Because see, if you are an analyst or an associate or a finance manager, you might still just jump into an offer, right? So if you are a senior executive, but before taking certain roles, you need proper due diligence, because it can either lift your career or just end it straight away. So your salary is important. Do you want to talk about government? The tax you are paying them is important, apart from tax, really, which is the number. How you are also acting, I mean, in terms of being a good corporate citizen now. Corporate citizen is also very important to government. I hope you don't engage in child labor, environmental pollution, and all of those things. Those little things matters, and that's why things has gone beyond just financial reporting. ESG reporting and some other reporting are also emerging, and we are paying attention to them these days, right? We can go on and on to talk about different stakeholders, but that's not what we are here for, right? And I mean, those are some of the things that you see here. Those are some of the things that you see here. Take a look at. It says employees, right? Your profitability and cash position, increase in salary, relative increase in profits, and dividend. Directors. So it depends on the level now. So a director, is looking at the remuneration you've paid over the years, right? So different stakeholders with different interests. But before we come back to this and use ratio to actually dive further into this, let's look at common size analysis. Now, in the next 10 minutes, you want to ensure you have fully understand what common size analysis is all about. So I'll allow somebody to read and read carefully, just 2.1, common size analysis. I'll be calling your name to read, or do we have anyone who wants to read? So anyone can actually read for us. Go ahead, Oyindamala. I think your hand is raised.
Okay. Introduction to common size analysis.
Yep.
Common size analysis involves expressing each line in a financial statement as a percentage of the base amount for that period. The common base amount in the statement of financial position is total assets. A statement of financial position can be constructed showing all lines as a percentage of that number. The common base amount in the statement of profit or loss is revenue. A statement of profit or loss can be constructed showing all lines as a percentage of that number.
That's all.
The analysis, okay.
That's all common size is all about. Take a look at it again. It says a common size analysis involves expressing each line in a financial statement as a percentage of the base item, of the base amount for that period. So that means there is a base amount. When you identify that base item or that base amount, you will now express every other item in that financial statement as a percentage of that number, right? So if, for example, like you can see, it says a common, where is that? It says a common base amount in the statement of financial position is the total asset, right? And then you can express every other item as a percentage of total assets. And you're wondering how useful will this ratio be? It's very useful. It shows you an entire picture, a good picture. I think we use this in case study a lot, right? Second bullet point says a common base amount in the statement of comprehensive income or in statement of profit or loss is what? Revenue. Is revenue. And then every other item in the statement of profit or loss can be constructed to be a percentage of that revenue, which you have identified as the base item. And that's what a common size is all about. A good example, as we had from last, so let me just come here. Can you see my screen?
Yes.
All right, so take a look at this. This was a financial statement that is given for a period of 3 years, right? A period of 3 years showing 2020 to 2022. And then we did a common size analysis here. How did we do the common size? And that's what you want to know now. From what we've read, we said for income statement, for example, we need to identify a base item. What did we say the base item is? Revenue. And then every other item in that statement is expressed as a percentage of that revenue. And that's what we've done here. Look at it. Revenue over revenue. Revenue over, sorry, okay, let's even do it together. So if you want to do this, we will just do revenue over revenue will give us this. Let me express it in percentage. And that will be 100% because you are using revenue to divide itself, right? So, but if you want to do for all other items now, sorry, what am I doing? Which one do I lock? No. Sorry. Yep, I think this should work just for easy calculation. Yep. So what we have done here, I think we can do the same thing across all the years, just to show you how we calculated all the numbers, and then we can explain. What we have done, let's pick operating cost or cost of sales as an example. Look at what we've done. We said 9,702 divided by 31,000, and that is we computing the common size for cost of sales. And this calculation then shows us that, oh, cost of sales is 31% of revenue. The same thing for every other item, like the bottom line now. Look at it. We did 3,799 divided by 31,000. You are expressing everything as a percentage of revenue. And that is what the common size analysis is all about. So when you do this over a number of years, it shows you a good picture. See, without doing a complicated calculation, see how you can make sense from how this company has performed in the last 3 years. Take a look at it. Take a look at this one now, since it's the same thing and we have the year on it. Take a look at it, right? I can see that my cost, we are not interpreting yet. Our second class is for interpretation, but I can see that my cost margin was higher in 2020 because I was doing cost of sales to revenue of 40%, and that margin dropped drastically to 28% in 2021, and slight increase though, but still okay at 31% in 2022, right? And I see that also reflects in my gross profit. If I look at, I'm interested in operating expenses now. Operating expenses was so high. Is that it? Is it operating expenses that is this high? Oh, wow, interesting. Very high in 2020. Can you see that? The operating expenses is even way more than our revenue. And that's why you see that the percentage to revenue is 108%, right? And then that dropped drastically to 52% in 2021, and they further dropped to 46% in 2022. And that's, these are some of the things that we see reflect in the improvement in the bottom line, because the bottom line was negative in 2020, which is why you have the negative number at the bottom line, and then it improved to at least a small portion, but 6% of the revenue in 2021, and that also improved in 2022. So when you do this over time, it actually shows you a very fantastic picture of how you've done over time. And this is a common size analysis for income statement. If you want to do balance sheet, the same thing. You just pick your total asset and you construct your balance sheet showing every other item to be expressed as a percentage of that total asset. With that, there are so many analyses, so many interpretations you can give. You can be able to tell whether your PPE, let's say PPE now, do we have PPE in this balance sheet? So if we do it for this statement now, we will be able to tell, oh, what percentage is our PPE compared to, the total asset over a period of time? Is it increasing or decreasing? If it is decreasing, I want to understand why. Did I dispose an asset? Why am I disposing assets? Am I considering liquidating? What exactly is happening? If it is increasing, oh, maybe it makes sense because I'm expanding, right? So those are things that you're able to, see clearly when you do a common size analysis. Again, you need to be able to do a simple common size analysis. What is it all about? Carry a particular financial statement, like an income statement, identify a base item, usually revenue, express every other item in that statement as a percentage of revenue. Take your balance sheet or statement of financial position, identify your base item, which is usually total asset, express every other item in that balance sheet as a percentage of the total asset. And you'll be able to see a picture, just like we are seeing for this income statement, how each of these numbers have done over time. And that's common size analysis.
Excuse
Any
me,
question?
sir, please, I have a question.
Yep, go ahead.
So does it mean that every time the base is always revenue in
Yep.
profit or loss and always total assets in financial statements?
Yes, exactly. So, and that's what you see here, that a common base amount is what? Total asset for this, and the common base for this is revenue. Now, let me give you a trick a bit, because it's not all the time that you will be dealing with a financial statement that you see, oh, revenue. A good example is when you are dealing with bank, that will show you interest income, interest expense, and all of that, a different structure. I have a special one here, like an insurance company. Take a look at my screen. Let me zoom a bit. An insurance company that will probably not report, oh, revenue, although the IFRS 17 has changed the reporting a bit, but I'm just showing you, using this as an illustration, that is not all financial statements that will be so smooth and you see revenue. A good example is also, if I could cite, let's say, ICAN. If you look at the financial statement of ICAN, you won't see revenue. You'll probably be seeing subscription income, this income, that income. So you want to, at the end of the day, understand the financials to know what to use as a base item. You can make your judgment, just make it reasonable, right? So on this screen, someone can choose to use this gross premium rating as a base item. Someone can say, oh, that is not a reflective of revenue. Maybe gross premium income will be a reflective of revenue, and then use this as your base item. It's all fine. The most important thing is that you've picked the most important item in that financial statement, and you've expressed every other item as a percentage of that item to be able to understand how each item has performed relative to that number, and also over a period of time. That's the most important thing. Okay, so we have to limit our questions, please, and please. But go ahead, Adegunwa.
Okay, thank you. So
Yeah.
how do we determine the most important assets on the
The most
financial
important item, right?
item? Yeah.
You don't need to stress yourself. Your syllabus has told you what you commonly see, which is, for balance sheet, it is your total assets. For income statement, it is revenue, and that's it. You can always work with that. We are only tweaking it a bit to say you could have a special financial statement, like an insurance or a bank, and you're wondering what is the base item for, especially the income statement, because balance sheet will always take the same. So far as prepared with IFRS, you always have your total assets, reported, right? But if you look at this insurance, it says gross premium written, right? And then from there, you deduct your unearned premium, right, to then determine your gross premium income. So this is the total income written, right? But this number, you can decide to use it as a base item. Just state your assumption, it's fine. But someone can then look at it and say, okay, we've not earned this now. We deduct it, and then we can use our gross premium income as our base item. So this is not to say that you are wrong by doing. In fact, this should be more correct than the first one. But using the first one is also not wrong. So these are aspects that an examiner, if it is not clear like this, an examiner will now tell you what to use. Using your gross premium written as the base item, do this. So this, life is easy, so don't take it too far. The most important thing you need to know is that, following the regular financial statement. Base item for financial position is total asset. Base item for statement of comprehensive income is revenue. And I hope that makes sense.
Yeah, thank you.
All right. All right. So let's now dive into, let's dive into ratio analysis. Let's dive into ratio analysis. And let's pay attention. I have a good note here in Excel which has summarized all the formulas which we are going to be speaking to. And it means you don't need to be writing formulas. Please just pay maximum attention. That's all we need. Like we've said, the next 1 hour in this class, we'll be discussing these formulas, calculation, how to do this, how to do that. And then we are coming back in the second session to do to know how to interpret and also do a lot of past questions review. And that's what we're coming to do in the next, in our next class. Okay. But let's spend the remaining 1 hour to, really understand ratios, right? Ratio analysis, like I mentioned earlier, although the most important technique for carrying out a financial statement analysis, but you still need to understand that it's only a technique, right? It's only a technique. So, and that's why it is not even appropriate. Case study, guys, now, it is not appropriate to show your heading as your main heading. If you are doing this aspect in your case study report, it is not even appropriate to just write it as ratio analysis. It is more appropriate to say financial analysis or financial statement analysis. It is more appropriate than saying ratio analysis, as you can see. Because under there, you do common size. You do a whole lot of other things. You corroborate this information to make sense with all the numbers. You do a lot of things, right? So it is better for your heading to be financial analysis or financial statement analysis instead of putting it as ratio analysis. Are we on the same page? Case study, guys, answer me. Are we on the same page? Okay, good.
Yes.
Good. So let's look at ratio analysis. And ratio is just a special type or another type of technique we use in financial statement analysis, and we have 5 categories of ratios, right? I think I have a snipe here from your pack that says I hope you can see the snipe. Yeah. The main financial statement or the main financial ratios can be classified as financial performance, which we can call profitability, if you want to call it that way. Then you have working capital turnover ratio, which we can call efficiency ratios. And then you have liquidity ratios, debt ratios, and then investors ratio. So, it aligns with what we've put here, as you can see. We have 5 categories: profitability ratios, we have efficiency ratios, we have liquidity ratios, we have long-term solvency, and then we have investment ratio. Ido Kinde, you need to ensure you are muted at all times so that you don't stress me, I don't stress you, because I can disallow everyone from unmuting themselves. But I need participation. I love active class. So that's why I don't, and the only reason I've been mentioning control is just because this class is larger than usual. Okay, but please, let's cooperate. All right, so now these are the 5 categories, and guys, let us discuss, because it is important you know what each category is trying to address. And I will ask you, profitability ratios. What are we trying to capture with profitability ratios? What does it measure? Somebody. What does it measure from your previous study?
Investment, like profitability and profit, basically profit and as a measure over the investment that the business has made.
that the business has made. Okay, so that's a good one. The only thing I'm just looking for is maybe a more appropriate alternative word than saying profitability. Basira, do you want to give that a try? Another, maybe an addition.
I think profitability
It's
as
measured.
So let's use
I
our
think
raise of
it's
hand button. I called Basirat, please.
yeah.
Go ahead.
Profitability ratio is used to assess or evaluate the financial performance of an entity.
Very good. During a particular period or over a period of time. Let me just help you add that. That's a fantastic way to to put it really, and I will accept that for us to move forward. So she said profitability ratio is a ratio that you use to analyze how well a company has performed during a particular period or over a period of time. So it's a performance ratio. So you use it to measure performance, and that's why it is named this way, from this snipe that says financial performance, right? So that's it. And that's what profitability ratio measures. There is a past question we are going to review. I think it was tested at skills level, that you are expected to discuss in detail which of these, list your categories and discuss this. What we are discussing now, we'll look at that past question. So if you pay attention now, if they bring that in your diet, you're good to go. And if you see that question, you know that, no, I understand this fully now. Okay. So the next one is efficiency ratio. Do we have anyone who wants to try? Raise your hand and then I can call you. What does efficiency ratio measures? And then you can also get hints from this other name here. Oyindamola. Yep, go ahead.
It tells you the effectiveness of a company's operations over the period of time.
It tells us the effectiveness and efficiency of the company over a period of time. But in relation to what? I think that's where you now, that's the best way to wrap it up. In relation to what?
Um, in relation to, I don't know, they are probably dealings with both customers and their suppliers.
Fantastic. Fantastic, right? A good way to summarize it will be to say in relation to their working capital, which is the other name that was used here. They said working capital turnover ratios, right? So in relation, how efficient they are doing in managing their working capital, how fast are you able to turn over your inventory? How fast are you able to collect your receivable? How fast or how slow are you able to, manage your payable? I'm saying that carefully because there's something important we need to discuss, right? So that's what efficiency ratio is all about. Someone is asking you, you are able to explain what efficiency ratio is all about. How efficient you are, how effective are you, let's use the word efficiency, how efficient you are in managing your working capital, that is in managing your inventory, receivable, and payables, and all of these items that relate to working capital, right? So that's what efficiency ratios deal with. So let's now look at the next one. I hope you guys are following. Let's look at liquidity ratio. What is it all about? What is liquidity ratio all about? So I will call Jane. You can go ahead.
Okay, liquidity ratio is how companies measure their ability to pay up their current liabilities.
Fantastic. How are you able to meet I will change it now. How are you able to meet your short-term obligation? Thank you for that. Right? How are you illiquid? Are you liquid? Are you able to meet your short-term obligation? And that's why you will see that what we are basically doing there is comparing our short-term assets to short-term liability, which still borders around working capital anyways. But we basically compare a short-term asset to short-term liability to see whether you have enough money in short term to meet any short-term demand. They can easily come knock your door and say, my money now. Are you ready to respond to demands like that? And that's what liquidity ratio measures, right? And liquidity ratio, it depends on the organization now. For some businesses, it is not a serious one. But for some businesses, it is extremely serious. If you are talking about manufacturing company, liquidity ratios are very key. Although the most important one is even efficiency ratios for manufacturing, very, very key. But if you are talking about banks, for example, right, liquidity ratio is extremely important. And that's why it's also part of your prudential ratios for banks. Right? In fact, there are prudential guidelines when it comes to liquidity ratio. It's a serious one. Are we together? So it measures how you are able to meet your short-term obligation. Okay, then we have the fourth one, which is long-term solvency ratios, or you can call it gearing ratios, right? Plural now, gearing ratios. So what's that all about, guys? Do we have anyone who wants to try? You raise your hand and I can call your name. Just tell me, talk to me. Who is doing that? I'm waiting. Anyone that we've not heard their voice since we started this class. Mhm. Or we don't know how to use the raise of hand, I'm just checking now. Okay. Abimbola, you can go ahead.
And can you say that we used to measure how much debt a company has in their financial?
Yes, that's very correct. You probably want to flesh it up and and put it in a more professional way. Let me put it that way. Do you want to twist it a bit? You are very correct. Okay.
Maybe say measure the total amount of, I don't know, debt.
Okay, so let me give you a hint. So there is only a very slight difference between this number 3 and number 4. Liquidity ratio is a ratio that measures how you are able to meet your short-term obligation, as we already explained, right? So getting hints from that, what does solvency, long-term solvency ratio measures? What does it measure?
How you're able to pay your long-term debt.
How you are able to meet your long-term obligation. That's what it measures. Are you able to meet your long-term obligation? Those are some of the things we will be discussing here. I get it. When we get there, we'll be looking at your debt in relation to equity, in relation to your total assets, and all of that. But that's basically what your long-term solvency measures. What about the last one? Investment ratio. What does it measure? Okay, so just to wrap it up, okay, I think Madam Margaret, you want to give us that.
Yeah, it measures the rate of return to shareholders, the rate of return on their investments.
Okay, it measures the rate of return. It sounded okay. It sounded correct, but too specific now, right? Because it's not everything there that might even be measuring rate of return. So we probably want to put it in a broad, because we are still going to specific ratios now under each of this category. So we want to probably put everything in bucket and say, what general explanation can we give to investment ratios, right? So anyone to add to that so that we can move. I just want you guys to own this class. Esther, go ahead.
Okay, investors ratio measures how well the company is employing the funds that the shareholders provided.
Okay, thank you for that. And that's also very correct, but it could be specific. Is it even specific? Or because if we look at profitability, a ratio like which we are still going to look at, like return on equity, could be measuring the same. But just so we can move on, I want you to understand that while all these other ratios are focusing on how the company is doing in terms of profitability, how they are doing in terms of efficiency, how they are doing in terms of liquidity and also long-term solvency, this last ratio is actually special. This ratio focuses on stock market. And that's why the other name for it is stock market ratio, right? So it's basically looking at how the company is performing. It's also about performance, just like profitability is measuring performance, right? So this ratio is also all about performance, but how well the company is performing from the stock market angle. Of course, if you are talking about stock market now, which is where I will now align it with your explanation, is still all about how it's performing to the investors, to the owners of the company, right? So, and with that, we are aligned. But I just want you to understand that these are ratios that focuses so much on the stock market performance, right? And that is, explaining the categories of ratios. And if I call you back towards the end of the class to give me a summary, if I give you 2 minutes, which I will do, and I'll call names randomly, right? So ask questions now before we move. So if I call you to, within 2 minutes, give me a summary of profit of all these categories of ratio, will you be able to do that? Yes, you will. Any question before we move on? Is it very clear? Okay. Adegunwa, you have a question.
Yes, sir. Please, I didn't really get the investment ratios, what it actually speaks to, if we are to make it broad so that we don't make it short line or streamline to one particular thing.
Yep. So which is why I said it's also a ratio that focuses on performance. So it's a performance ratio from the stock market angle. That's it. So it's, and I said the other name for it, another name you can call it is stock market ratios, right? So it's a ratio that measures the performance of the company from the stock market side, right? So that's it.
Sorry, Simon.
Yep, go
I
ahead.
had a little network glitch. Which one are you referring to as the stock market ratio? Which one?
Number 5, investment ratio.
Oh, okay, thanks.
Okay, great. So we now want to dive further. We still have close to 50 minutes to dive further and look at specific ratios. Pay attention. This class is designed to be a very detailed one. For professional guys, they've attended, this topic before, they've done it before, they did it in FR, they even solved questions on it, but don't because of that not pay attention. One thing is, we learn better by actually, repeating the learning and all. And then another thing is that it's it's more important in your level than even a skills level, because it's everywhere, right? That's one. And two, there's so much attention on how you actually interpret your numbers, right? And that's why case study, we talk about your calculations not even fetching you much, but how you are interpreting your numbers matters a lot. And everything starts from now. All these discussions that we are having, knowing the purpose of your ratio on a very high level, knowing it at the specific ratio level, and knowing knowing everything about your ratio very well really, really helps a lot. Okay. So let's now start with these ratios, and we are going to discuss. So there are some of these categories of ratios that we'll spend good time to actually discuss in much detail, like the efficiency ratios. We will spend good time here, right? Some other categories like investment ratio, we'll spend good time. So, but what we want to do now is let's discuss the ratios under each of these category, and just have good level of details so that when we come back in the second class to do interpretation, we have a very easy flow and we just do more of past questions, review. Okay, so take a look at profitability. We have identified some ratios that you can possibly, have under profitability. Of course, this is not exhaustive. You can have more ratios under this, really. But we've identified return on capital employed, ROCE. This is the most popular, measure of profitability, right? And then you have gross profit margin. You have net profit margin, you have asset turnover, you have return on equity, and then you have return on asset, right? And how do we calculate this? See, it's very simple. Sometimes the ratio itself will tell you its formula, and that's the first way to tell you how to get your formula. Like I said, most of the time, the ratio itself will tell you its formula. Let me give you an example. A good example is return on capital employed. You can first of all look at it on a high level and say, oh, if the ratio is going to give me the formula, that means the formula should be return over capital employed. Am I correct?
Yes.
Yes.
That's it. And that's how it should be. And fortunately, that's what the formula is. So return over capital employed. So is then a question of, do you understand what return we use? And do we understand what we mean by capital employed? Are we together? And I will try to break it because there are so many aspects that you see EBIT, EBIT, EBIT. EBIT is at this level, right? EBIT is what is regarded as your operating income, and that you can also call it net, net profit, right? But EBIT is what is regarded as operating income, and that is the income before you start distributing to providers of capital. From the structure of your published account, right? Published financial statement, you have revenue. Take a look at it here. Let's just go to one of the statements. You have revenue, you have cost of sales, you have gross profit. Here I've settled all my suppliers. That all the guys that supply what I sell or what I used to produce, I've settled them at cost of sales level to determine my gross profit. Any other operating income, I have added it. I've considered impairment. All my operating expenses, I've considered it. All the salary, everything that I need to pay, distribution expenses, admin expenses, I've deducted everything to now have my operating profit. This operating profit is what is regarded as EBIT. In the traditional accounting, this is your net profit. In your traditional accounting method or format, this is your net profit. But now we use the International Financial Reporting Standard, right? So it is at this point that you start distributing to the guys that provided capital, except the special guys, which is government. And what do we mean by that? The finance cost. Finance cost is the money you pay to the debt providers. Although if you have finance income, you also consider it in this line, especially if it is if you are not into lending or any interest as your primary income. Any finance income, you just bring it into this line to set it off against your finance cost, right? So your finance cost is the money you pay to the debt providers, and then immediately after that you settle government, and then this bottom line is your profit for the year, which we can also take as profit attributable to ordinary shareholders. It is at this point that you will say, oh, okay, let's go and settle the shareholders. Should we pay them 100% as dividend? That means we distribute this entire money as dividend. Oh, do we have preference share? If we have preference share, maybe we settle them their preference share dividend before we say, okay, this is what is left to be attributable to the ordinary shareholders. And that's the structure. But let me go back up. I hope you are following. This is the level at which you call, or the level you call your operating income, which is your EBIT, earnings before interest and tax. Right? And this is what you use to actually assess how well a company has performed. This is the most important number for assessing the performance of a company. The money you made before you distribute to any capital provider. I hope you are following. Are we together? So in computing your ratio, the most important profitability ratio, it is that EBIT that you use. So, and that is why we said this is also your operating profit, the profit from your operation before you distribute. And then before I attend to questions, let me just also explain the concept of capital employed. capital employed is all the capital you have employed, both debt and equity. So one way to think of getting your capital employed is to say, oh, equity plus debt. Or you can say, you can also use, let me use that same template. That means take a look at this balance sheet. If I'm looking for my capital employed now, this is a long balance sheet. Let me just collapse it. So if I'm looking at this balance sheet now, pay attention. One way to get my, somebody tell me my capital employed.
Total assets minus current
liability.
Total assets minus current liability. Total asset, I will now do this. Total asset, this is total asset here. Minus, let's just do it here. Capital employed equals total assets. You take this minus, where is your current liability? Here, they gave you the total current liability here. Take a look at it. This is the summation of your current liability. Are you with me?
Yes.
And this is how to get your total asset. Total your capital employed. Another way to get your capital employed is what? What other way?
Equity plus total non-current liability.
Equity plus non-current liability. So I can easily pick my total equity plus this non-current liability. That's it. And it will give me the same thing. So for the purpose of your notes now, we can say capital employed. The first one is total asset plus, minus current liability. While this one is total equity plus non-current liability. And this is what we've done. Now, in reality, someone who already understands financial statement fully will now say, I won't work with this number. Okay. Should I skip this? Okay. For the purpose of, because we have professional guys here who have done this before and are also hungry for deeper details, especially for their case study, right? So someone who is already very knowledgeable in financial statement analysis will say, I will not work with this number because it should not be correct. And then that person will now be looking for what is not missing and say, oh, my capital employed, instead of working with this, let me look at it very well and look at the actual capital employed. And if I really want to look at the actual capital employed, I should be looking at my equity. I should be looking at my equity. Take a look at someone who fully understands financial statement. So we say my equity. I can also add let me add borrowing, but you see these other things. Deferred income is not really it. I won't consider it. Contract liability, I will consider it. This, like, it's a good one. Okay, deposit for shares. This, in fact, if this has been done, has been finalized, it should be under equity already. But let me just also capture it, even though it's sitting under non-current liability. You see this defined benefit liability. This is related to, employee benefit, right? And it's long term in nature, and I can consider this now or not consider it. It depends on your perspective. Deferred tax liability, I can decide to ignore it, that this is not really, and someone can even go under current liability and say, okay, this borrowing that I see here, I can decide to also include it. Wait, I think I missed something. This. And then this, even under current, I can decide to include this borrowing here, because what this person must have done is to analyze the borrowing and try to break it into the component, the non-current part, which is the part that you still have over 1 year to pay, and the part you need to pay within 1 year, and the person decided to categorize it under current liability. And that's what this person has probably done. On that basis, I probably want to add this as part of my capital employed. Someone can be doing this, and at the end of the day, you see that you're just stressing yourself. Everything is approximately approximately the same thing, 91K, right? See, I will now use that to emphasize on something. I will use that to emphasize on the fact that when you are doing ratio calculation, not interpretation now, when you are doing ratio calculation, it is not about the correctness of your number. The most important thing is the consistency. If I have done this over a period of 3 years and I'm using it as my capital employed, it makes sense. If I've also done this and used this number over a period of 3 years, it makes sense. I'm fine. I'm consistent in whatever I'm using as my capital employed. And it's also reasonable. It's not totally unreasonable to use any of these two. Are we together? So the attention is not really on the correctness of the number. That oh, I missed that, because I didn't include this. I will be getting a 0. No, it doesn't work that way. Are we together? So the consistency, you could see if by the time you get to case study level where the industry they are testing, you pay so much attention to it, and for case study guys, I'm speaking to you now, where you might not even be given a regular financial statement in your exam. You can be given a bank financial statement, and all you are seeing is interest income, interest expense, this one, that one, or even an NGO financial statement where you are seeing subscription income, donation, right? There is nothing like ROSE in that case. You are probably looking at surplus to total income ratio. You are probably looking at funny ratios. The same thing with banks. You are probably applying your CAMELS, model to analyze the performance of the company. And you're looking at non-performing loan ratio to, a whole lot of funny ratios. So you have to really understand the industry that you're analyzing, right? So it matters. And the same thing when you're also looking at your numbers. So the consistency is what really, really matters, not about the correctness of the number you are using. I hope that is noted. But that's just trying to emphasize on this, the importance of EBIT and knowing what EBIT is all about. You see that in that financial statement I showed you, they didn't call it EBIT. Oh, there is no EBIT here. What is the EBIT in 2021? Somebody, let me call a random name. Don't give me a chorus answer, please. A random name. Adewumi Abisola. What's looking at this highlighted figure? What is our EBIT for 2021? EBIT for 2021. EBIT for 2021. Adewumi Abisola, are you with us? EBIT for 2021. Okay. Afis Ganil, do you want to try? What's your EBIT for 2021?
1767.
1767. Do you want to look at that very well and give me an answer? Because what you said, I don't think that's what it is.
Sorry.
Your EBIT.
5835.
Very correct. Thank you. So your EBIT is operating income, right? Your EBIT is your operating income. Please take note of that, because EBIT is extremely important when you are doing your profitability ratio, and that's why you see it everywhere. So EBIT over capital employed, we've discussed that capital employed. So before I attend to questions, let me just discuss other profitability ratio that we have here. So you have profit margin, gross profit margin, and net profit margin. Gross profit is just looking at this number. It's looking at this number. So it's looking at this number basically after you've considered your cost of sales. So what do you have left? So your gross profit number as a percentage of revenue is also the same thing as your gross profit ratio. But your net profit ratio is still your EBIT over revenue. So for gross profit, for gross profit margin, you are using gross profit. For net profit margin, you are using EBIT. And I hope that is clear. Then both over sales or over revenue. Asset turnover, that should normally give you its formula, but it is the other way around. So you could look at it and say, oh, asset turnover is asset over turnover, but no, that's not the case. It is turnover over asset because that ratio is not expressed in percentage. It is expressed in number of times. How many times are you able to turn over your asset? How many times are you able to use your asset to generate revenue? That's what the ratio is looking at. So instead of saying asset over turnover, the ratio is looking at asset turnover over assets. And it is expressed in number of times. What you see from all these ratios is that I try to attach how they are expressed. So you see most of the profitability ratios are expressed in percentage, except this asset turnover. Your efficiency ratios are expressed in number of days, and you see all those indications across all the ratios. Just take note of them. So asset turnover is turnover over asset, right? And then return on capital employed, return on equity, this is for equity guys now. So the return you should use to calculate return on equity is the return attributable to equity holders. So we said return on capital employed, we use the return attributable to the entire company capital providers, which is why we are using that income before we make distribution to any capital provider, which is EBIT. But if you are talking about return on equity, you need to use income that is attributable to those guys, the equity holders. So if I have this financial statement, take a look at it again, right? It means I should be using this last number to calculate my return on equity. So the return I'll be using is my net, my profit for the year, my last net income, right? So if I even have preference shares, I will not be using this. What will I be using? Somebody talk to me. Afis, do you want to try? If I have preference share in the company, will it make sense for me to still use this profit for the year to calculate my return on equity? Inolua, do you want to try? I'm calling you because I can see your face on top of my list here. Inolu, are you there? Okay, so who wants to try? I think I've even mentioned it before.
Yes, but I don't have idea.
Okay, great. So anyone, do you want to try? If I have preference share, will I still use this to calculate my return on equity?
No, it doesn't make sense to use that. We need to remove the portion at the
You need to remove your preference share dividend. Thank you. You need to remove your preference share dividend. And that is why that formula, I've carefully documented it as what? Profit attributable to shareholders, or profit attributable to equity. See, and that is because most of the time, your PAT, which is profit for the year, right, is exactly what is attributable to ordinary shareholders. But when you have preference share, you need to settle them their dividend before you pay the ordinary shareholders. So if you are solving a question that you have been giving ordinary preference shares, you need to deduct their dividend before you proceed to use it to calculate your return on equity. Very, very important. And then the last one is return on asset, and that's just your EBIT over total asset. At that point, you're also looking at it from the total, or from the company's level. So it's always more appropriate to use EBIT as a percentage of your total asset, and that's our profitability ratios. So questions on profitability ratios before we move on. I think I had somebody's hand. That hand has been lowered before you, Precious. But go ahead, Precious. It's fine. Questions?
Okay, thank you. My question is, what if, when calculating return on equity, what if you use the profits for the year and you factor in not just the capital of the ordinary shareholders, but the capital also provided by the preference shareholders?
Thank you very much. And that will be that's a very intelligent approach to it, but that will not be correct, right? And the reason is that when it comes to preference share, there are complications. I mean, in financial reporting now, you need to, if you look at your IFRS, your IAS 32, which is where if you have a problem of preference share, you want to understand, should I treat it as an equity or I should treat it as a debt, right? And you will find out that preference share is always closer to debt than equity, right? So it will be more inappropriate to factor in preference share when we are computing return on equity. Equity is the word now. It will be more inappropriate to do that than being appropriate. And so why I'm being careful in telling you that we are not correct with what you said is that when we talk of preference share, we have different types of preference share. There are preference share that can give you voting right. There are preference share that can give you a cumulative. There are cumulative preference share. There are participating preference share. There are different types of preference share, convertible preference share, different types of preference share. So it means you can also have a preference share that is very, very close to equity. And in that case, such preference share can even be added, in computing return on equity when it has all of those factors that takes it closer to equity, right? But like I said, generally, preference shares are usually closer to debt than equity, right? And that's because preference share has a fixed income nature, right? It has a fixed income nature. And when that income, that's preference share dividend now becomes cumulative, it is automatic debt because there is an obligation. Even if you are not able to pay me this year, my preference share dividend, I will cumulate it for next year for you to pay. The only thing that is probably setting it apart from debt is that you have to settle debt, guys, before equity, which is a long discussion for SFM guys, right? Yep. So the more appropriate thing will be to separate it and let equity guys enjoy what they are enjoying for taking higher risk. And that's it.
Thank you.
Yep. Did this hand come first? Tommy, Lola, you can go ahead.
Good afternoon, sir.
Yep.
So the asset turnover, I don't understand what you said. I don't understand the asset turnover. Let me just put it that way.
Okay, so the asset turnover, I think the first thing I said is that, I said earlier that sometimes the ratio will always tell you its formula, but you then realize that for asset turnover, except if you want to confuse yourself, so you really need to understand how to compute that. So, and how do we compute it? Asset turnover is computed as turnover over asset. So I was saying, if you look at the ratio name itself, you can easily say, oh, asset over turnover, but that's not it. It is turnover over asset. And that is because that ratio is expressed in number of times. And I guess I didn't explain that further. But what we mean by that is I have 100 as my revenue. And I've only generated this, that's 100 million. And I've only generated this with an asset of asset of 20. So if I do an asset turnover, it will be turnover over assets based on what I just said, right? Are we together?
Yes.
Good. So I'm just saying that this 5 is expressed in times, or you can say times this way. So what it means is that the asset we are using to make revenue, we generated 5 times of that value in revenue term. And you can see it from the number. I use a simplified number so that it will be very clear. It's not always this straightforward because you could see 1.8 or 2.7 or something like that. But this is it. You could see that the asset you are using is 20 million, but you generated the revenue of 100 million. And that means you generated revenue that is 5 times of your asset. Or did I put that correctly? But you basically generated revenue that is 5 times of your assets. And that's asset turnover. So the number of times you are able to use your asset to generate revenue, that's 5 times. So this is what asset turnover measures, basically. So the formula, if I click on what I did, is turnover over asset, 100 million divided by 20. We are going to talk about interpretation, and that's in the next class. So just focus on the calculation for now. I don't know if it makes sense now. Can we proceed?
Yes, sir. Thank you, sir.
All right. So because of time, one more question, and then we can proceed, please. I think that's Nina.
Good evening.
Yep, good evening.
My question is on EBIT. So, in analyzing the financial statement of a financial institution, will the net profit still be considered your EBIT?
Yes. So no matter what, there will be a structure that will be called net profit for EBIT, for that's EBIT for a financial institution. Because for a financial institution, apart from the regular thing, apart from the special items, you will still have the regular stuff. And by special item, I mean, I'm looking at the typical structure now, and you have your interest income at the start. Is my video still on? Just to be sure. I think it is. Okay. I think it's because of the hands that are raised. Okay. So you have your interest income, you less your interest expense, and you have your net, your gross profit, or that's net interest income, as it should be. But after that, you then realize that you start deducting the expenses that are regular, like every other business. Your admin, your what is it? Your admin, your other running costs, basically, right? If you have impairment and all of those things, also deduct them. And then the moment you deduct those things, you have your EBIT. For finance cost now, it is different from the interest expenses you have under your below your interest income. We said interest income, we have interest expense. The interest expense we mentioned in that line is the interest you pay to your customers in their account, on their fixed deposit account, on their on your interbank loan, and so many other things that you pay direct interest on. But if you have guys who invested in your company by way of proper debt, right, the money you pay to them, the interest you pay to them, is what should still fall under your finance cost, even as a bank. I don't know if that makes sense. So I'm separating the two interests now.
Yeah, thank you. That was actually my confusion. I wanted to be sure that finance cost did not equals it's not the same thing as
Those
interest
interest
expense.
expense. Yeah. So
Yes.
yeah, I get that. So because you still need to mirror the issue of your income and direct cost. So a direct cost for that business of banks now, right, is that you get people's money, and that money is like your raw material for like a typical manufacturing company. So you get those money, you pay interest on them, like your fixed deposits, the savings account, and all those accounts, your interbank, relationship money that you move and pay interest on them. Those are your direct interest expense, right? So it is different from the fact that if you have lenders money, you still need to pay incur finance cost on them. Yep. So I think we can proceed and then we can attend to more questions later. But that's basically analyzing our someone needs to mute, ensure you are muted so that we can keep enjoying the class, please. That's our profitability ratios. Anyways, sorry, 1 minute. Some people are writing on my screen. I'm just trying to clean it. All right, so let's talk about efficiency ratios and pay attention. We've said efficiency ratios are those ratios that test how efficient you are in actually managing your working capital, right? How efficient are you in converting your inventory to money or to sales? How fast are you in converting your sales, your receivable to cash? How fast are you in, settling the guys that you owe? So at the end of the day, we have these three important ratios. You could also see text that we categorize asset turnover. Please, you could see text that will categorize asset turnover under efficiency ratio. It's fine, but it's more appropriate to sit under your profitability ratio, especially with the fact that it has a relationship with this your return on capital employed. I'll mention it very fast, but come back on it later. Just to let you know that your net profit margin times your asset turnover actually equates your return on capital employed. And that's what I tried to explain here, that net profit margin times asset turnover equals your return on capital employed. And you can break down the formula to understand it, how that equals. So you know the formula for your net profit margin is EBIT over sales. And your formula for asset turnover is sales over capital employed. That's your total asset. You can also use the word capital employed. And your EBIT is also EBIT over, your return on capital employed is EBIT over capital employed. So if you do this now, sales, we cancel sales here. You will now end up having EBIT over capital employed left, which equates your EBIT over capital employed here as your ROCE. And that's how it works. When we start looking at past questions, we play with numbers to see how that equates. But that's it. And in interpretation, I will use something like this to tell you that when you are interpreting and one ratio needs to lead to another, you actually follow that chain, right? For example, the reason ROCE might have fallen could be attributable to either the net profit margin side or the asset turnover side. You want to break it down to understand. If it is related to asset turnover side, is it as a result of the asset you employed or the income side? If it is, if it is on the net margin side, is it related to your pricing or what exactly is, leading to it? So you want to understand those things and use them to guide your interpretation. Get there. So these are basically the three ratios we are going to be looking at under your efficiency ratios, and that's inventory turnover period, your receivable turnover period, and your payable turnover period. Follow me. The formulas are very simple. Your inventory turnover period is average inventory over cost of sales. Your receivable, so look at it, average turnover, inventory turnover rather, inventory. So we are focusing on the average inventory divided by cost of sales. But for receivable turnover period now, we still use average receivable, but over credit sales. I'm still coming back to all of this. So it's supposed to be sales, but let's use the word credit sales, right? And then if it is payable, we still use the word average payable over credit purchases. Now, I'm going to dive further on some of these things. And let me just copy them somewhere. Okay, I think I have it here. Now, take a look at this. I'll start with this. The word average, whether it's applicable to inventory receivable or payable, average has to be opening plus closing divided by 2. Only when you can get opening and closing. I'm going to explain further, but you need to pay attention so that you don't, draw us back because you're not paying attention. So let's all be together. So I said, if you want to determine what this average is, whether it is for inventory, I'm explaining the three at the same time now, whether it is for inventory, for receivable, or for payable, average is your opening plus closing divided by 2, provided that you can get both opening and closing. So it means if I want to do opening for 2020, take a look at this example. Take a look at this example. If I want to get my average for 2023, I should easily know that my opening will be the number for 2022 at the end of 2022, which is 222. I will now add it to the number at the end of 2023, which is 230 divided by 2. That gives me the average for 2023. If I want to get my average for 2022, I will do 222 plus 205 divided by 2. If I want to get my average for 2021, now I need opening. So this is where you now need to get very clearly. So consistency matters, and I've mentioned that before. So I can only do this average when I can get opening and closing for all the period I'm looking at. If I cannot get both opening and closing for all the period, I will take the number for each period as the average number. I will explain further. So for example, if I'm giving only this information as the inventory for 2021, 2022, 2023, I can see that for 2023, I can get both my opening and closing. Usola, you are not muted. Usola, you are not muted. Let's ensure we are watching just to be sure we are not distracting the class. So for 2023, I can get my opening and closing, right? As already mentioned. For 2022, I can get my opening and closing. But for 2021, I can only get closing. I don't know what the opening figure coming from 2020 is. So if I'm facing this situation, I will regard this actual number as my average number, meaning my average inventory in 2023 is 230, in 2022 is 222, in 2021 is 205. But if you have a question that really wants you to do an average like this, what they will normally do is they will give you an information like this, and then maybe in the additional information, they will now tell you that, oh, the opening, the inventory at the end of 2020 is so number. You know that now you have opening and closing for all the years. You now need to do opening plus closing divided by 2 to determine your average. I don't know if it makes sense. Let me know. Okay, so let me attend to 2 questions and then we can proceed. Sadiq, you can go ahead.
So in the situation where 2021 is the first year of accounts preparing financial statements, what will be the calculation?
So, and they didn't, if I get you now, you have 2021, but that's your first year. And they didn't give you any additional, so there is no opening inventory because there is no 2020. That's your first year. And then what I said here applies. That means the only thing you have been given is an information like this that is appearing on the screen. You take that as your average inventory. Except if you have been told that you should now do your calculation or your analysis for only 2022 and 2023, then you should be able to do average. Meaning for 2023, I will use 2023 and 2022. For 2022, I will use 2022 and 2021. And since I'm not calculating for 2021, I don't need to bother. That means for the years I'm calculating for, I have my opening and closing. You just need to be able to get opening and closing before you do average. You need to be able to do get opening and closing for all the years before you average, or else use the actual number as your average. Okay. Oyindamola, and then we can proceed.
Okay, so my question is to the profitability ratios.
Profitability.
Yeah, like I had a question then, but then it's
Okay.
I just want to get a clarification on that.
All right, go ahead. We can no longer hear you.
I said, is there a reason why we're using net profit margin for why we're using EBIT rather for net profit margin? Because I understand that there's also something called EBIT margin. So in that case, what is the difference between two of them? Because I mean, I just felt that net profit margin would be the profit after tax, which is net profit over the sales. Then your EBIT margin is the EBIT over sales as well. So I'm wondering why we have EBIT being used for net profit margin. That's the
Yeah.
question.
Okay, very, very good question. So if anyone calls it EBIT margin, it's just a name that that person has chosen to give it, right? To say, oh, EBIT margin. The same way I can say maybe PAT margin or EBT margin. I can come up with that. PAT margin, EBT margin. EBT means I've probably done my interest now before tax, right? The same way we have also done maybe EBIT margin or even maybe EBITDA margin, right? So we can come up with those things when we are doing a comprehensive analysis. Can come up with EBITDA margin, EBIT margin, EBT margin, even EAT margin. Those are different levels you can come up with just to understand how each number relate to revenue, right? But what we are looking at here is a standardized approach, right? Which is net profit. And the analysis I did earlier, if I go back to that sheet, is that even from the traditional accounting format, what is regarded as your net profit is your EBIT, your revenue, cost of sales, and all the expenses from operation, right? So, and that is what is regarded as net profit from the traditional accounting side. And that is the same thing that also reflects in this, when we are doing this analysis. So everything that happened here, you see from here to the bottom, is not as a result of your operation. And that is why, if you notice, I also added that the most important profitability ratio really from the company side, for looking at the entire picture of an organization, is return on capital employed. We can also use ROIC, anyways, return on capital invested, which is quite similar to this. But let's just focus on what we have in the syllabus. So return on capital employed, right? And this return on capital employed is looking at the return that you have made on the capital employed. So will you now, let's even look at it that way. Return on capital employed. How will you now deduct this, which is part of the return you are paying to capital employed, before you regard it as, does it make sense? You know that this money is what you're also paying this money to a portion of capital that you have employed. Take a look at it.
Yes.
Yeah. So this money is being paid to some of those guys that for SFM guys now. For SFM guys, they are going to do this. I mean, everyone in this class, because even you skills guys will still get there. There are areas we do this in more detail that will help you to even appreciate it when we start looking at valuation, right? Where we're able to look at free cash flow from both equity to the firm and all of those things. And that's where you need to understand, this even in a better way. But let's just put it that way for now, just to let you know that for the purpose of calculating profit margin, operating profit margin, which we call net profit margin, you actually work with EBIT, right? EBIT is what regards to as net profit for the purpose of doing your return on capital employed calculation. And that is because that's the profit you report before you start distributing money to the providers of capital. And that's basically how it works. Like I said, don't confuse it with the names, the different nomenclatures that we can use when we are working as an analyst. So like I said, we could have EBIT margin, EBITDA margin, EBIT margin, PAT margin. Different margins can come up. So yeah, I don't know if that helps, but one more question and then one more question now on this
Yes,
one.
sir. Thank you.
Okay. So still on the average. I hope that is clear. Let me go back to that sheet. The average now. I hope that is clear. Average inventory, because I want to go to the denominator. Okay, so I want to believe it's clear. Now, on the denominator, we said cost of sales for inventory. That's always clear. If you get your cost of sales, just use it to divide your average inventory to get your inventory turnover period. But another issue here is that why we have credit sales in the formula, is it all the time that you'll be able to determine your credit sales? If you are not able to determine your credit sales, assume all sales to be on credit. Please take note of that. The same way, if you are not able to determine your average, your credit purchases, assume all purchases to be on credit. In fact, let me add, it's not even all the time that you are able to determine your purchases. If I'm not able to determine my purchases, I will use my cost of sales instead of purchases. I want to be sure you've been able to capture everything that I said. Let me repeat myself, and I'm speaking to the denominator now, where you are dividing your average inventory with cost of sales. I said most of the time you have your cost of sales, but for average receivable over credit sales, if you are not able to determine your credit sales, assume all sales to be on credit. It means instead of saying I'm looking for credit sales, I'll just pick my sales figure and use it in the formula. Instead of looking for credit purchases, pick your purchases number, use it in the formula. If it is not even possible to determine your purchases, use your cost of sales as a reflective of your purchases and move on. Just be consistent. That's all that matters. So, Precious, go ahead.
Thank you. Please, I just wanted you to sort of explain this inventory receivable and payables turnover period. So the way I want you to explain it the way you explained asset turnover. So you had said the asset turnover is used to measure how much our revenues generate the So I want you to just help
I'll
it.
get there. So we are breaking it bit by bit. So the first part was focusing on, the numerator of the formula, the denominator of the formula. The next thing I would like to take you to is the fact that when we compute our inventory, so in fact, inventory, receivable, and payable are regarded as your working capital. These are the key working capital components, right? And these three numbers, we use it to measure efficiency, how efficient you are in managing your working capital. So there is another ratio or a term that you can use to capture these three, which is called the cash conversion cycle or cash operating cycle, right? So cash conversion cycle is the number of days, which is why these ratios are also expressed in number of days. So cash conversion cycle is the number of days that it takes us to convert our short-term asset or our working capital to cash, right? So if we want to break it down now, how many days? So these are the three components. How many days does it take us to convert our inventory to sales? When we sell it and then it sits in receivable, how many days does it take us to receive those money that we have in receivables? And net of how many days does it take even we to settle our own suppliers, right? So overall, cash conversion cycle measures the number of days it takes us to turn around our working capital. Cash conversion cycle, right? So that's it. And now, cash conversion cycle, as we explained, measures the number of days it takes to convert our short-term asset to cash. I'll ask you a question now. Is it the longer the better or the shorter the better? Cash conversion cycle.
The shorter.
Shorter.
The shorter the better. The shorter the better. Imagine if you buy, let's be very practical now. Imagine if you have a supermarket that you manage, that you operate, right? So the faster you can sell those inventory, the better. Are we together? The same way with receivable. You've sold to guys. If it is possible for them to even pay in advance, the better. So the faster you can receive the money people are owing you, the better. Do you agree with those two things?
Yes.
Yes.
For payable, which is why we are netting it now, the longer the better. Because in this case, you are the one holding people's money. The longer, the better. Are we together? But we usually say something here. Hold carefully so that you will not spoil your reputation. Right? So the longer the payable days, the better, but you should hold carefully so that you don't overhold. Don't hold people's money for too long so that they will not be running from you. Are we together? So that's basically that's like helping you to understand each of these ratios and how it translates to your cash conversion cycle. Are we together? We will come back to this during interpretation, though, because you now need to know, what do we need to do? A whole lot of things that we still need to discuss. Okay, but because of our time, let's just move to discuss the others, and then we can come back to do interpretations after we have a break, right? So I will say liquidity. So liquidity, we've already mentioned it earlier, that liquidity ratios measures how you are able to meet your short-term obligation, and the most common ratios under this are current ratios and acid test or quick ratio, and then a very rare one you can also have is cash ratio. What does this really measure? Current ratio is just looking at your current assets versus current liability, and you can express this in ratio 1. This is expressed in ratio, actually. So you can express it in ratio 1. So, but the difference between current asset and acid test, let me repeat that. The difference between current ratio and acid test or quick ratio is that for quick ratio, you are looking at it from a quicker side, right? So you are taking a not very liquid component of your current asset, which is inventory. You're taking it out. So you are looking at current asset minus inventory to see how the remaining portion can cover your liability. And that is why we have the formula to be current asset minus inventory over current liability. And then the last one is, let's not even look at money that is outside. Let's not even look at inventory that we've not sold. Let's look at actual cash we have at hand or in bank. How many times, or what is the ratio of it to the liability that we have in short term? And that's what cash ratio is looking at. So cash ratio is looking at only cash. How can it cover the liability? Quick ratio is looking at very quick assets, like the money you have in bank plus the money you the receivable you have out there, or any other short-term asset other than inventory, right? While current ratio is looking at your entire current asset, including inventory, as a percentage or divided by current liability. You express it in ratio 1, and then when we come back, we'll still talk about interpreting this as well, and then we'll look at questions also. Okay, So please just pay attention, and let me just run you through, and then you can ask questions at the end. Note your questions so that you will not forget. Okay. I hope you are not joining this class without notes. Okay, so the next one is long-term solvency ratios, and we said that ratio deals with your ability to meet your long-term obligation, and common ratios under this is debt to equity ratio, debt to total asset ratio, and interest cover. And for debt to equity ratio is just debt over equity. So these are ratios that tells you its formula: debt to equity ratio, debt over equity, debt to asset ratio, or what you can call debt to total capital ratio. That's basically debt over equity plus debt. Interest cover is basically the number of time your earnings can cover your interest. So that is your EBIT over interest. So you see how important EBIT is. So that is the money you make before you start distributing interest. So it is EBIT over interest. Some people prefer to also express this in percentage, so they call it interest coverage ratio, right? So in that case, it will be interest over what? EBIT, if you want to express it in percentage. And if I want to make it clear for you, if I have my EBIT to be 100 and I have my interest expense to be 20. So if I compute my interest cover now, what will it be? It will be 100 divided by 20, right? And that will give me 5 times. Is that not? Is there any difference between this and interest coverage ratio, which can be written as 20 divided by 100, and then we put it in percentage? This is the same. So if you understand the number, you will see that they are the same. Interest coverage ratio is telling you that interest is 20% of your EBIT, right? Interest is only 20% of your EBIT, but interest cover is putting it the other way around to tell you that your EBIT can cover your interest 5 times. Does it make sense?
No, sorry, please repeat.
You're muted. I didn't hear you. I should repeat which part?
The interest covering.
So the interest cover formula is EBIT over interest, right? And I said some people prefer to express this as interest coverage ratio, which will now be in percentage. And when they want to do that, they transpose the formula whereby it becomes interest over EBIT times 100. Right? So I put this for you to understand that it will give you the same interpretation when you're analyzing, really. So I put, let's say EBIT number is 100, interest is 20. If we want to apply this formula as it is, interest cover, it will be, look at it, EBIT over interest, and that will mean 5 times. Do you get that? Is this clear?
Yes, yes.
But if you want to express it the other way around, like I said, where it will now become interest over EBIT times 100, that will then become 20 over 100 times 100. And that's what I have here as 20%. I'm now saying, if you look at the interpretation of these two, they are interpreted different way, but meaning the same. If this is saying interest is 20% of the EBIT, while this one is telling you EBIT will cover interest 5 times. So the same thing, really.
Okay, thank you.
Yeah. All right. So that's for long-term solvency. Let's spend the remaining time on investment ratio, and then we can have a break, right? So investment ratio, this part is very, very important. I don't know if anyone is offering SFM in this class, but this part is extremely important for you because it's always very difficult to teach merger and acquisition when you don't even understand when when you don't even understand investment ratios. The most difficult aspect of merger and acquisition is when they want you to manipulate your numbers with your investment ratios to be able to arrive at a certain position. So you must understand your investment ratios very well. Are we together? So, and it starts with your basic profitability ratios, which is EPS, right? I said this is also analyzing your performance, but only from the stock market side. So earnings per share is just earnings per share, your earnings per share. So earnings, which guys are we talking about here? So let me ask you, are we looking at the entire company, or are we looking at only things that relate to equity holders from what you can deduce here? Are we looking at the entire company or the equity holders?
Equity holders.
Equity holders, please take note of that. In fact, stock market, like I said, this other name is stock market ratio. So it's all about the shareholders now. But there are different names you can give it. You can call it shareholders investment ratio. So what we should be looking at, so if we are talking about earnings, so let me give you two earnings. Should this be PAT or EBIT? Should this be EBIT or PAT? If we say earnings at this stage, based on what we've said.
PAT.
PAT, thank you, because it is the earnings that is attributable to ordinary shareholders that you should use. Now, based on the discussion we had earlier, you said we should use PAT. Now, let's even create a scenario that we also have preference share dividend. Are we going to use PAT?
No.
No.
So what are you going to use?
No.
We deduct the one attributable to preference shareholders.
Simple. It then becomes PAT. It then becomes PAT minus preference share dividend. You take out what belongs to preference share. Are we together? So with that, you need to, because you see, that is what understanding ratio analysis is all about. It's not about the formula. You need to know what the stakeholder you are addressing. Are we together? So EPS, you can then say it is earnings divided by number of ordinary shares. So if EPS is earnings divided by number, see how I'm going to take you through these investment ratios now. They look like they are a lot. How many ratios? 8 ratios. But see the journey. Earnings per share, very straight. Earnings over number of ordinary shares. We are just trying to express it on per share basis. If earnings per share is earnings over number of ordinary shares, what should dividend per share be? Dividend over number of ordinary shares. So, very straightforward. Now, another ratio which tells you what to do is PE ratio, price earnings ratio. Price earnings ratio is this just as it is. Price earnings ratio is price over earnings. So, and that's why you see us saying PE ratio equals market price per share over earnings per share. That's because we probably want to work with on per share basis, or we can even do total and say market value over total earnings, or market valuation or market capitalization over total earnings. Are we together? So that is your PE ratio. So PE ratio, so very easy. Don't stress yourself. PE. What is P? Price. What is E? Earnings. So it now depends on whether you want to work on per share basis. Per share basis means you work with price, market price per share. That means you need to, divide with earnings per share. If you are working with total valuation, you work with total value divided by total earnings. Picking up. Are we together? So now, if interest cover is EBIT over interest, what is dividend cover? If interest cover is EBIT over interest, what is dividend cover? With that, you can see that you don't need to think, right? You should remember it anytime, any day. It's very close to interest cover. The only difference between the two is that you cannot use EBIT. We used EBIT because we were still looking at the earnings before we settle the debt, guys. But now we are looking at shareholders. Any earnings you must use must be at shareholders level because it is dividend we are talking about. So if we are talking about dividend cover, Don't go and say EBIT over dividend though, because you had EBIT over interest in under interest cover. So you need to know the stakeholder. You can see that clearly now that you must be addressing the stakeholders' interest. So dividend cover is your earnings attributable to ordinary shareholders over total dividend paid, which is earnings per share over DPS, or total earnings over DPS, over total dividend rather. So because I'm trying to make these formulas make sense to you so that you don't cram these formulas. It doesn't make sense to cram. You forget one and then that one can put you in trouble. Now, if earnings yield, earnings yield is just a transpose of your PE ratio. Your PE ratio is market price per share over earnings per share. That's P over E. But earnings yield is the other way around of it, like transposing the formula, which now becomes EPS over MPS. So instead of writing MPS over EPS, you are writing EPS over MPS. Your earnings yield, you are just expressing your earnings per share as a percentage of your market price per share. That's your earnings yield. And the moment you know your earnings yield, you don't need to think about your dividend yield. If earnings yield is earnings per share over market price per share, dividend yield will be dividend per share over market price per share. Are we together? Are we together, guys? Just to be sure.
Yes.
Okay. And if you look further, we said payout ratio. What are you paying? What are you paying out? What are you paying out to the dividend? Dividend. Payout ratio is the portion of your earnings that you have paid out as dividend. So without even thinking, in this case, or if my earnings is 100 and I've paid out dividend of 80, what is my payout ratio, guys? In terms of
20.
the 20, in terms of the amount, my payout is no. So let me repeat myself. My earnings is 100. My dividend is 80.
80%.
Good. So I paid out 80. So my payout ratio is 80%. So what did you do to get 80%?
80 divided by 100.
80 divided by 100. So do you now agree with this formula that says DPS over EPS? D over E, or you can also get it as total dividend divided by total earnings to give you the same thing. So look at this. If I may ask, if you paid out 80%, what did you retain?
20%.
20%.
Very clear.
20.
Very clear. And that is why you can easily do, your retention ratio is 1 minus payout. That's what I left under this table. Take a look at. That your retention ratio, you can do 1 minus payout. But a standard way to just get it is to say, earnings per share minus dividend per share divided by earnings per share. And what are we saying? We are just saying, look at it. Earnings per share is 100 minus dividend per share 80, everything divided by earnings per share will give us 20%. So you need to go through this yourself. Flow with this formula. This formula is very important. If you are skills level, this is a good opportunity to fully understand your investment ratios so that they don't stress you in SFM. If you are doing SFM now, you are doing, it's a good opportunity to fully understand this so that, when we get to M&A, it is like you're eating pizza and you're using Coke to dilute it. It's very important. The stressful part of merger and acquisition is when we expect you to play around this figure and have your way. If you don't understand this ratio very well, it's then stressing you out. Are we together? So that is the flow, and these are the formulas. Of course, this note to be shared with you so that you go through these formulas again. Try to review past questions by yourself. I will give you an assignment. My assignment after this class is usually to review all diets for CR guys and and FR guys. For case study guys, don't worry, your report assignment is starting soon. That's after this class. But the assignment is going to be for you to review all diet, and I'm going to drop a poll on each level group where I will expect you to indicate when you have gone through all the diets. So we'll put a timeline to that. And as you've gone through all the diets, I will expect you to go to the poll and indicate. I'll pin it on each level group to indicate that you've gone through all the diets for ratio, that they tested ratio analysis. That's usually my assignment. And because for CR guys, have you ever seen what the trend looks like? Let me show you so that you understand the importance of this class. Case study. Let me start with case study, guys. Case study. This is your past question chart. This is what you are looking at today. Area 1. You see it every diet, financial analysis everywhere. Where is even SFM guys? That's what you have here. And even some other topics like M&A that I say you need this for. CR guys, see what the trend looks like for what we are doing today. So have I given you assurance that you will see it in your diet or not? Anyways, you should know whether you have assurance or not. Let's go to FR guys. FR guys, see what you are doing in this class, how important it is. Just to be sure, can you see my screen?
Yes.
So this is just to tell you how important this topic is. So what we've done is to go through the formulas in detail, and I want you to ask questions before we have a break, and then we come back to just do interpretations and review past questions. Just a short one. Questions. Now I can attend to questions, please, so that we can leave. Let's make it fast. We've used, I think this was even supposed to be till 6.
Yes,
And
we
then we'll
have
come
already
back.
exhausted the break.
Wow. So when we come back, please, let's use only 1 hour, 30 minutes and be done. So our break will just be for
From
30
7
minutes.
to 7. Sorry, from 6:30 to
The
7.
next class is supposed to start 6:30, right? 6:30, right?
Yeah, I'm
Yes.
saying the break will now be from 6:30 to 7.
Oh, yeah. So we can do 7. Yeah. We can come back at 7 exactly. So let's come back at 7, and then we manage maybe just 1 hour. I think 1 hour, 20 minutes or 1 hour, 10 minutes should be fine, because this is all really. So what we just want to do is to understand interpretation. Okay. So questions, guys, or you want to keep it till we're back?
My hand
I
has
have a
been up.
question.
Oh, Precious, your hand is raised. Go ahead.
My hand was raised too since.
Please, can you differentiate between debt over equity ratio and debt over equity plus debt? I'm not sure
Okay.
I can do it very well. Thank you.
Yeah. So if I go to this financial statement, so one is looking at, where is that? I think we completed it. Okay, we only looked at debt to equity just to save their time. Okay, so for assumption, permit me to take the total non-current liability as debt. So equity, so debt to equity now. Debt to equity is looking at my equity. Sorry, debt. So I've made the assumption that allow me to take my total non-current liability as debt. Time will not allow us to.
No problem.
Divided by equity. And then that tells me that this is 45%. But debt over asset, right? Or which is equity plus debt, right? Or let me just put it clearly. Right? Is you are doing debt, which is this, divided by this, equity plus same debt. For SFM guys, the question you ask usually cause a lot of trouble as well when we get to some aspect, but they will navigate it when we get there. So this is equity is just equity. Equity plus debt is your total capital, right? So if I look at debt to equity, it is telling me whether the equity is actually greater than, whether equity is greater than debt, right? So for example, this 45%, I can see that this company, it depends on the industry anyways, but this company is still not highly geared because their total debt in relation to equity or is only 45% of their equity, right? So it's not anywhere close to the equity, and that's what debt to equity measures. Debt to equity measures your debt as a percentage of the equity, right? So from what we see here, debt is only 45% of equity. But debt to asset is measuring your total capital. So in your capital structure, as far as this computation is concerned, debt is only 31%. In your entire capital structure, debt is only 31%.
Okay, so this brings me to a follow-up question to this. Now, this equity plus debt is like your net assets.
Equity plus debt, no, your net asset is equity. That's actually your net asset. So another name for equity is net asset. We all shareholders fund. That's your net asset. So net asset is equity.
Okay, so why, if we're comparing our debt to the total capital, why don't we include current liabilities?
So current liability is a working capital. So it's not a capital provided for long-term purpose. Don't forget that we mentioned here the major distinction between liquidity ratios and long-term solvency ratio is that long-term solvency ratio focuses on your ability to meet your long-term obligation, right? So there is no non-current component in that calculation. And that's why you see that we focus on only non-current when we were picking figures here.
Okay.
Yeah. So debt to equity ratio. Your skills level, right?
Yeah, I am.
Okay, I wanted to say maybe we'll discuss this further in SFM class. But it's the confusion you're having here, you don't actually need it here, right? The confusion you have here is when you get to SFM, where computing cost of capital, sometimes you need to use debt to equity ratio, sometimes you need to use debt to capital ratio, and all of those things, yeah, so we try to clarify because they will now give you, let's say, oh, debt to equity ratio is maybe 40%. You now need to understand from this percentage what is debt amount, what is equity amount, so we get to clarify that. But for the purpose of your ratio computation at this level, all you need to know is that there are 3 ratios you can compute to assess your level of solvency. Debt to equity ratio computed as debt over equity, debt to asset ratio computed as debt over asset, or you can call it debt to total capital ratio, which is debt over total capital, that's equity plus debt. And the third one is interest cover that we already discussed. Okay. The last question before we need to close at max to 6:30. So Mr. DME, go ahead.
Sorry,
So I dropped a question on the chat.
I've been raising my hand since profitability. So that asset turnover, sales over capital employed. This sometimes when you were talking, you were saying sales over assets. So I want to know, because if capital employed is total asset minus current liability, so which of it are we using for the asset turnover?
Thank you for that question. For asset turnover, we are calling it asset turnover, but the assets we are actually looking at. So what is looking at is just the nomenclature we are using for the ratio, but it's looking at the asset employed. The asset employed, it can be used interchangeably as capital employed. So you are looking at the number of time You make revenue with the assets you employed. That's the capital you employed. Don't mind the nomenclature. So asset turnover is turnover over asset, or turnover over capital employed in the real sense.
Okay. Sorry, for return on equity, is there a difference between shareholders fund and equity?
No. So I mentioned it as well. Did I put that note somewhere? I think I mentioned it just now, that another name for, where can I keep it? Equity is shareholders fund or net asset. Please take note of that. Equity, shareholders fund, net asset, they mean the same. Does that make sense?
Yes.
All right. So any other question? Let's keep it to our next session. So let's meet by 7, and then we continue to just wrap it up with interpretations, review questions, and then we attend to questions from you. Thank you for your time so far. See you by 7.
Thank you, John.
Yep. Bye.